Good evening and welcome to this live stream event on the 7th of July 2020. I'm Martin North from Digital Finance Analytics. Great to have you on board for another in our weekly series of live shows. Today we're going to be looking in great detail at mortgage stress, rental stress, and also investor stress. First time actually on investor stress, a whole bunch of additional information that we've been running through our models, so that'll be exciting. Great to see everybody on so far. Lots of old names and some new names too. Welcome to you all. I haven't got time to acknowledge everybody now because otherwise we'll be doing nothing but that all evening. But great to see everybody on the stream tonight. And what I want to do just initially is quickly go through the running order for tonight. Which is pretty straightforward. Introduction, done that. House rules, just to say, it's important. There are just a few things that we need to say each time just so that everyone's on the same page. Talk about our models, go through a few key slides, including our mortgage stress slides, and then there'll be questions and answers. And we'll sign off after that. Typically, this runs for about an hour and a half. Come. Maybe longer, maybe shorter, depending on how we go. And if we're going to deep postcodes, maybe a little bit longer. So just in terms of house rules, please understand this isn't financial advice. I have to say this every time. I'm not qualified to give financial advice. This is just my own analysis, my own opinion. And, the fact of the matter is if you need somebody to help you, guide you, go talk to them. You probably have to pay a fee, but they will be able to tailor advice to your particular circumstances. I can't do that here. So this isn't financial advice, just a general chat. Also, please play nice in the chat room, no racial slurs. Plexus is doing a great job in terms of just keeping things under control. And if we do get some trouble, we'll clean it up very quickly. So I appreciate Plexus's help once again. Tremendous for just keeping the channel clean and clear. And this is as at the 7th of July 2020. I'm sure if you follow this in playback, months, years later, things will be very different. But this is as at now, and in fact the data that I'm presenting shortly is as at today as well, because the information came in this morning. Please use that Walk the World if you want to get my attention on the chat. There are always lots of conversations. I can't necessarily engage around all of them, but if you do use that Walk the World, there's a greater chance that I can see it and act and respond appropriately. We also do have Super Chat enabled, so if you would like to make a contribution to the channel, that's one way of doing it. And indeed, if you want to make sure that your question goes to the top of the list and gets noticed, you can use Super Chat, so that is another way of getting my attention. Just want to say that for those new on the channel, I use my own custom methods and approaches in my analysis, and it's all based around my core market model. And the point about the core market model is that it is essentially pulling information from our household surveys. We run those continually through the year, 52,000 in the model at any one time, 4,500 each month, 1,000 a week. The latest came in today. So it's right up to date. We also do the same for the business sector, and we also pull information from other sources, including all the public sources. We then put that through our market model, and that then leads us into a sort of set of activities, including supporting our YouTube channel with the data, doing work for clients, writing reports, and a bunch of other things too. But the point I want to underscore is this is not just based on opinion, it's based on data. And personally, I think that data is a really good place to sort of spend time on, because it really does get beyond some of the speculation and some of the rubbish that people out there in property land often speak. We also have the ability to slice and dice the data lots of different ways. So, for example, we can cut it by property status, we can cut it by geographic locators. We can segment it through different segments through our master algorithms. And that means that we can start identifying different types of people and what they're up to as well. And that becomes very important when it comes to all the things that are going on at the moment. Now, just on the Reserve Bank, because they published their comment, very brief comment today, that didn't change the rate, of course. So the policy rate is precisely the same at 0.25%, and indeed the 3-year Aussie government bonds at 25 basis points too. So that really signals the long-term rates being very much the same. for a long time. They're saying, I think it's going to be 3 to 5 years before things change. So the second point is they're talking about the severe downturn around the world, and I think that's pretty clear now. Everybody is recognizing that. The question is, how severe is it? They also spoke about the fact that financial markets have improved, volatility has declined, and that's one of the interesting points. They've thrown so much money, the central banks, at the financial system that the volatility has gone back into more normal levels. But, of course, the value of assets is shooting very high relative to the real economy, so you could argue that the markets are disconnected from reality, and that always suggests it could collapse later. Now, in Australia, the Reserve Bank has essentially done very little since its first bond purchases. They've purchased 50 billion. They are prepared to scale up the bond purchases again, and they say we'll do whatever's necessary to target the rate if it's required, but at the moment it looks as though it's relatively tame. So that's quite an interesting observation. They also said that financial services organisations were drawing from the liquidity facility. That's one of the things they put in place. So the central bank is effectively supporting the financial system directly. They also made the point that there was a very significant rise in unemployment. 800,000 people lost their jobs. And remember that that's really a very understated view of the situation, because there are many, many more on JobKeeper. About probably 2.5 million people on JobKeeper. So the real situation is a lot more dire than that 800,000. Of course, the unemployment rate is a lot higher in reality compared with the 7.1% that's being quoted by the ABS. We did a show on that quite recently. Go and have a look at that if you want to get more information about that. They also made the point there was a bit of a pickup in retail spending. Of course, this was pre-COVID Mark II. So the question is, will the Victorian events over the last few days change that ahead? Probably it will. They also made the point that many households and businesses remain cautious, and that level of confidence and the lack of it potentially is, I think, a very big deal. There was more data out today that suggested that consumer confidence had actually gone backwards, and that's partly, I think, to do with the Melbourne situation. And they also made the point that it's likely that fiscal and monetary support will be required for some long time. Well, nothing new there. They keep saying that. And they also say that they will do whatever it takes in terms of maintaining that strategy into the long term, and really will do nothing on rates until the employment rate comes way back. And so the question is, unemployment is going to probably stay very low unemployment's going to stay very high for a long period of time. It will probably be a long, long time before it comes back to the lows where it was before the COVID. Now, just a couple of points. You may or may not have picked up the fact that the lockdown in Melbourne is back for 6 weeks. There were 191 cases today. You can see there on the left of the chart the very big steep line up. That, of course, is Victoria, gone very high. The other states, less so, although there's a little bit of an uptick in New South Wales, but nothing like as much as it was. And unfortunately, I think it's going to take a long time to get this under control. And so expect more lockdowns and more difficulty ahead. And, it is unfortunate, but many businesses will have to close again. It means that a lot of the SMEs who are thinking of reopening and being able to actually drive their business forward won't now. So that's a big deal. Also, it's just worth highlighting this. This came out from the Fin Review today, that there are a few areas where the government support got thrown to businesses and consumers, but of course there's a question as to whether it will actually be quite that same. So, for example, the Fin Review said that family businesses might actually find they get a bill from the tax man for some of the loans that they got to help them through. We also know that the ATO is also looking quite hard at some of the superannuation payments that were made urgently. And of course, the latest from APRA shows that the payments now is about 19 billion in total. That's, bearing in mind that people could get a first tranche one side of the financial year end and the next tranche the second year. And if you've got a couple, you can accumulate 40k in total. So, but the ATO will be reviewing and perhaps even wanting to claim back some of those payments. So it's not necessarily a free ride. A lot of the superannuation funds are quite concerned by this continued leakage, of course, and I expect to see it continuing for some time yet. And by the way, from my surveys, quite a few people who've grabbed superannuation probably can't really justify it in terms of impact of COVID. So it'll be interesting to see what the ATO does. CoreLogic just made the point that property prices down again. This is today's index, and apart from Brisbane and the Gold Coast went up very slightly, but all the others are down. Perth, of course, is now down nearly 22% from its peaks, and unfortunately, the Western Australian property market looks going to slide further, despite the fact that there are incentives in Western Australia, particularly around the land package processes. And you may have picked up from one of my earlier comments that a couple of months ago there was around, let's say, 200 packages sold in a month. Last month it was 1,600 packages, thanks to all the stimulus packages. So people rushed in, and in fact the price of land went up thanks to the supply-demand disequilibrium. So these incentive schemes, frankly, are a bit of a waste of space in my view. It's a net-sum game. Now, in terms of mortgage and rental stress, as normal, should explain, this is based on cash flow, so money in, money out. And in terms of money in, we think of income, we think of pensions, interest, dividends, all other sources. And in terms of money out, we think of all the various expenditures that households have. And we build effectively for each of our survey respondents a mini balance sheet and P&L that says what's coming in, what's going out. And the reason I do it like that is because it's really then trying to understand what it's looking like from a cash flow perspective, despite the fact that some may well have other assets. They might have investments or assets. But if it's on a cash flow basis, more going out than coming in, close to zero, then we put them in stress. If they're severely underwater, we put them in severe stress, and that's the way we do it. Others will use 30% of income on mortgage repayments, but frankly, that is just impossibly difficult. It doesn't really tell you very much. This is a much more accurate way of getting where things are, so that's why we do it like that. And in terms of mitigations, people can do various things like cutting back on spending, drawing down deposits, putting more on credit cards, and even reaching for other credit, buy now, pay later, payday loans, all those things. And that's one of the reasons why Afterpay is doing very well at the moment, relative, in fact, to the debit, to the credit balances on credit cards, which are actually going down quite fast at the moment. And, the point is that mortgage stress is an early indicator of trouble ahead. And I keep using Mandurah as my case study. Western Australian mortgage stress at Mandurah went very high a few years ago. And that then flowed through into falling house prices, higher levels of default, higher levels of negative equity, and particularly property investors getting caught as well. And in fact, in Western Australia, in Mandurah, prices are 38% down, 38% from their peak back in 2006. So don't think that prices can only ever go up. They can also go down as well. Now, when it comes to mortgage stress, this is the latest information. So this is as at the end of June, and in fact incorporates some information for the last few days, because effectively I updated the information on Tuesday. And the point to make here is that mortgage stress is now at 39.1% of households. Now that's up from 37.5% last month. And that means that more than 1.47 million households are struggling with cash flow issues at the moment across the country. And to try and understand that, it's worth asking the question, well, what's changed? Well, the first is we are seeing more what I call structural unemployment. So structural unemployment is effectively the fact of people struggling with job loss, but not casual job loss, not part-time job loss. These are corporate jobs that are going. So, for example, from the consulting sector, airlines, So we're seeing more structural unemployment, and that means that more people are getting hit. The trouble is with those is they were on bigger incomes. So effectively, their incomes would not be replaced by a JobKeeper or a job seeker. And that's creating a huge financial pressure for quite a few people at the moment. And unfortunately, my expectation is that more businesses will indeed right-size, in other words, lay people off until they can be more confident of what's happening later on. And, that's quite a big deal, really, in terms of what's going on. Also, we've got JobKeeper. You've got some returning workers, particularly for some sort of retail areas and some restaurants and cafes, those sorts of places like that. There's also, of course, the bank postponement mechanisms for some mortgage holders. Not a huge number, but quite a few have taken advantage of that. There are certain rules and regulations around that they have to be able to prove. And there are many investors, property investors, who've actually not been able to avail themselves of that particular facility. There's also, of course, some refinancing to lower rates and also switching to interest only. And APRA has said quite recently they're very comfortable, and Assets Confirmed, very comfortable for people on existing mortgages to switch to interest only mortgages if that helps. Trouble is, of course, there that 2 or 3 years ago, after the Royal Commission, everyone was complaining about the fact that interest-only loans were a real problem because the capital still has to be repaid later. So it's rather gone on, the other direction at the moment. So that's the overall mortgage stress story. Now, what we can then do is we can actually drill down a little bit further and just go to there first. And here is now the state information first. I haven't done charts this time because I had people last time said, I'd love to see the real numbers. So I've done real numbers. So I hope you can read them. And it's worth saying that if you go over to the side of the chart, you can see here that we've got average in stress down the side here, 39.1%. And then over here, we've actually got each of the states. So if I go back to there, you can see that, in fact, Tasmania is at 49.4% of households in mortgage stress. So they have the highest proportion in the country at the moment. And not a vast number. So there's essentially around 40,000 households in Tasmania of the 85,000 who are borrowing there. And then we go to the Northern Territory. It's a very small number, of course, because it's a relatively small territory. And then you go to Victoria. So Victoria has 41.8% mortgage stress, and that's quite a bit higher than previously. That's 406,000 households in degrees of difficulty. And it's also worth making the point that there are some there risking default. Not a vast number, but 25,000 risking default in Victoria, compared with 18,000 in Queensland and 26,000 in New South Wales. And in fact, as you go down the list, you can see that New South Wales actually has the lowest level of mortgage stress at 36.2%, but that's still 408,000 households in difficulty. And you can see there that the biggest losses are likely to come from New South Wales. But I want to highlight again, Victoria is, to my mind, one of the most critical areas to look at, because the default rate is actually as high in Victoria as in South Australia. And, WA is 4.7, so that's actually a lot higher, but that's been running for a long, long time. So there's a bit more stress, a bit more pain and higher defaults in Victoria, now of course locked down. Now we can also look at this by our segments as well, and again it's sorted the same sort of way with the percentage in stress. 39.1% is the average. Young growing families, including many first-time buyers, are the most stressed, 69.2%. And then we've got some battling urban and disadvantaged fringe households. And then we go into our mature, stable and suburban mainstream. But we've also got exclusive professionals and even young affluent households. They are the more affluent part of the market, and they have issues too. And note that the exclusive professionals has the largest risk of loss, because they're highly leveraged, they've got very large properties, they've got very large mortgages, often multiple mortgages. And so quite a lot of the risk in the system are actually at the top end of the market there. And what's one of the things that many of the lenders, I don't think, fully recognise, that the risk profiles are much more tilted towards the more affluent households. But I'm also concerned about some of these first-time buyers, because we're seeing quite a few first-time buyers who bought in relatively recently, within the last couple of years, getting into trouble. And unfortunately, quite a few of them are actually experiencing now unemployment or loss of hours and inability to service the mortgages. Now, we can also look at the data a different way too, and this is basically across the regions. And the point about the regional analysis is not to go into it in massive amounts of detail. It's just too much on the page. But I want to highlight the fact, and of course there's a couple of anomalies. We've got very low numbers, like 225 households in the New South Wales part of the Canberra area. Those numbers don't mean much, so ignore that. But if you look at some of the others, you can see there that we've got big representations in places like Sydney, for example, and quite a few in Brisbane and Moreton Bay. But you've also got quite high levels of stress in other regional areas too. And one of the things that I want to highlight is that mortgage stress is not just in the main centres, it's also in the regional areas as well. And this is just the rest of it. So you can see there, Adelaide's got 220,000, 102. And the whole point about this is that there are large pockets of mortgage stress in places beyond the urban centres. Now, the top stressed postcodes nationally, this is just the start of the list. Maybe not too much surprised in a way. Ballarat is right at the top there with total in stress of 6,994 households. And then we go across to 6030. That includes places like Clarkson and Merriwa and Queen's Rock and Tamala Park. And that's 6,950. Now, I've flagged that as young growing families because a lot of those are new purchasers buying on those new estates on the outskirts of Perth, north of the and south of the main CBD. Then we go across to Melbourne with places like Sydenham, 3037. And then we go to Cranbourne and Cranbourne South. I wanted to call out, we've got quite a few wealthy seniors, now older households in those postcodes, as well as young growing families. Quite a few of them are now in difficulty as well because their incomes have been crimped, not least because of the income from deposits, which is almost non-existent now. And then we go to Point Cook and Werribee, 3030, another Melbourne one. Then we go to Melbourne, 3810, Pakenham and Pakenham Upper. Young growing families again, another 6,000 there. Hoppers Crossing in Melbourne. You can spot the common themes. Melbourne, 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 Melbourne. And that's the point I want to make, that we've actually seen high levels of stress in our top postcodes in a number of Melbourne postcodes. So again, my belief is that we've got a lot of difficulty in and around Melbourne. Then we go across to the west there at Stirling, in places like Ellenbrook and Upper Swan. Then we come back to into Sydney, like Harrington Park, Mount Annan, places like that, Narrowvale, and Central Tablelands, places like that. And then Mackay, and Mackay, of course, includes quite a few little towns and quite a few big towns as well. It's a large area, more than 5,000 there up in Queensland. Then we go to Adelaide, 5108, and that's there is around Salisbury. And then we go back to Melbourne to Craigieburn and Donnybrook and Roxburgh Park, that's 3064. And then we go to Brisbane, Moreton Bay, and then we go back to Sydney, and on it goes. So the point I want to make is that there is a significant range of postcodes that are actually stressed. But one, the numbers are rising, and two, there's a consistent pattern in the types of households who are actually being recorded as stressed in these large numbers. A lot of them are out of towns, urban fringe type developments, modern developments. Quite a few of them actually are with people with higher levels of income and bigger mortgages because they're highly leveraged, and then suddenly their incomes have disappeared. So that's what I'm seeing at the moment. Now, if we can quickly go through to rental stress. Now, rental stress is looking at cash flow, but when paying rent rather than with a mortgage. And there, 1.78 million households are in rental stress at the moment, and that is 39.4% of all renting households. And you can see there that it varies a little bit, but Tasmania, again, at 56.3%, has the largest amount of proportionally speaking, rental stress. And then we go to Victoria at 40.5% with 471,000. Then some in South Australia, Western Australia, 38.2%, 38.2% in the Northern Territory too. ACT at 38.1%, New South Wales at 37.9%, but with 726,000 in rental stress there, and 36.8% in Queensland with 318,000 there. Now, this is a very big deal because many people, of course, are struggling. In some cases, they've had rental repayment holidays, but some haven't. And in some cases, they've tried to negotiate with their landlords unsuccessfully. So that's all part of that picture. Now, in terms of by segments, and again, it's the same segments as last time. So you can see there that, there's a range. Young growing families, yep, again, 122,000 of them are stressed, largest. And then we go to the disadvantaged fringe and the battling urban. That's the same sort of scenarios that we saw with with mortgage stress. And then we go to other areas like the exclusive professionals. And then the young affluents are the least stressed, but there's still 173,000 of them with difficulty. And you can see that the largest group, and this is a bit different from mortgage stress, the largest group is the suburban mainstream. So these are people, more mature families. They'll have kids at home, kids at school, whatever. A lot of them are also struggling too. So this is, again, quite widespread. And we can also look at it by top postcodes. Same sort of idea as previously, but note that Melbourne, 3,000, has the largest count of rental stress, 13,714. Now, that's explained by students who are there and not earning perhaps the part-time work that they were, and a lot of them live in and around the centre of Melbourne. It's also explained by the fact that many people living in rented property in that central area are paying big rents because they've traditionally had to do that. And some of them are now running out of smoke when it comes to making those rental repayments. And then we go to 2560, which includes the area around Campbelltown. There's 9,000 there. And then we go across to Liverpool, 2170, with 8,800 there. And then we go to 2770, which is another New South Wales postcode, and another 8,700 there. And then we go to 2540, and again, a long list of different locations like St George's Base and Sussex Inlet, a few other areas, 8,600. Then we go up to the area around Toowoomba, 4350, with 55.7% of renters in that area stressed, 8,415. And then we go back to New South Wales, and then we continue in New South Wales around Gosford, so the Central Coast, 2250, with another 7,789, and so it goes on. 3030, which is Durham, Point Cook and Werribee again, 7,181 in mortgage stress, 31 in rental stress, 31.7%, and so it goes on. There is some correlations between rental stress and mortgage stress in some postcodes, but there's also some quite big differences, like 3,000, very strongly stressed when it comes to rental stress. Okay, now let's go to property investor stress. Now this is new work that I've been doing. And it's quite complicated, right? Because the first thing, in particular geographies, you'll have properties for rent. And roughly there's about 3.2 million properties for rent across the country, give or take. And many of those will be individuals, but they could also be owned by firms as well. Now, you also have got a number of rental property owners, but the rental property owners don't necessarily live in the same place as the rental properties. Right? So you might, for example, be living in postcode 3000, but actually you have rental properties in 3010 or something like that. So we are representing this both ways, right? From the renting perspective, we know what the rental stress is. Here, we're talking about the property owners in a particular area, postcode or geographic area. And then we can identify what proportion of those are stressed. Now, here we have to use a few different mechanisms. We can't just use cash flow directly, although that's part of it. So we've included things like, was the property vacant? Is it in negative cash flow in terms of money in, money out to service the mortgage? Are they trying to get rid of the property? All those things are in the mix to be able to identify whether they're actually stressed. We also identify which are severe stress. So this is a subset of the stressed investors. And you can see there that of the 2,875,000 rental property owners, there are around 833,000 who are stressed, and that's about a quarter, 25.9%. And you can see it varies quite considerably by different postcodes and different states. So in the New South Wales area, it's 35%. That's actually the highest proportion of stressed investors. That's, again, let me be clear, that's where they live. That isn't necessarily where they have their property. So they might be, for example, living in New South Wales, renting in the West, for example. But that's important because if those decide to essentially sell up or try and get rid of the property, right, it puts pressure on the postcode where they're living as well as the postcode where they're trying to sell. Okay, so that's that part. Now, the next thing then is to look at this across our segments. And what you can see immediately is that there are some quite different proportions. The most significantly stressed group from an investment perspective are young affluent investors. And that's 55.6, so more than half of young affluents. And in fact, 49.3% of exclusive professionals, so the more affluent end of the investor property set, are the ones who are actually struggling with cash flow. Not surprisingly, if you think about it, because they tend to have multiple properties, they tend to have bigger properties, they tend to have bigger mortgages, and in many cases they now find them vacant. And we can also then go down the list, and you can see there that young growing families are around 26, and the disadvantaged fringe are somewhat low as well. And there's a relatively large number of those who are financially less sophisticated. I would say most people in these disadvantaged fringe area probably would be, in the battling urban, less sophisticated, but quite a few of them have got investment properties. And the question is, do they really understand what they're into in terms of their investment properties? The fact of the matter is that it's actually quite complicated to really get to the heart of what's driving them. But I can tell you that many of the disadvantaged fringe and the suburban and the battling urban are actually very inexperienced, and their net rental yields are actually much lower than the exclusive professionals or the young affluents. But even the young affluents and the exclusive professionals, at 49.3 and 55.6%, are indeed struggling. And this is, I think, a big deal. Now, we can also then look at where, and this is actually by suburbs and postcodes, and you can see here that it's actually postcode 2010, which is Surrey Hills, where the number of stressed investors is largest, 4,260. And that's a big deal. That's 79% of property investors in that postcode struggling. I think that's pretty stunning. Now, of course, some of them will be renting property in and around the same area, others differently. Then we can look at the next one, which is 2,000, so New South Wales CBD, and there 80% of investors are stressed, but there's a smaller count, so that's 3,500. And then we can go to the inner suburbs like Randwick, and then we go to postcode 3,000, Victoria, Melbourne. So guess what? In the top 4 or 5, you've got Victoria again, 3,000. 3,000 was the very same place where we have the highest levels of mortgage stress and the high levels of rental stress. There are huge issues in the property market in and around Victoria, Melbourne, CBD, in my view. And we can go down the list a bit further, South Yarra, St Kilda. Then we come back to New South Wales, Rushcutters Bay, and then we go to Newtown. They're in the inner suburbs. And the point I want to make is a lot of these postcodes are in the inner suburbs or close to the CBD. And it tells you that some of the more affluent people, those who actually have quite a portfolio of properties often, are actually quite often in difficulty. Okay, last thing to talk about before I come back to the Q&A is the scenario. So I've updated my scenarios once again, and I've taken account of all the information up till early this evening. And of course, scenarios are just a way of considering the futures. It's not saying it's a prediction of exactly what's going to happen, but it gives you a relative feeling based on my modeling. It comes out the back of the core market model, as I just showed you. And so basically in my RBA baseline scenario, this is essentially if everything went as the RBA thought it would, there is still a trajectory possibility over the next couple of years of a small house price rise, maybe 5%, but there's equally, I think, a chance of a small fall. And I give that now a 10% weighting. I gave it a 20% weighting last time, but now COVID is back, and I'm taking account of that and some of the other data that I'm seeing in my modelling. As a result of that, my best case, as I call it, in other words, this is what I think is what could happen if things went really, really well. Very low cash rate, unemployment rate 7.5% in a couple of years' time, mortgage stress at 40%, and prices between 5 and 15%. And this is basically baseline now. So there's a further drop, a few percentage points, and I've given that now a 20% weighting. There's a longer term crunch scenario where effectively things get longer down for longer, higher unemployment rate, higher losses, some more significant home price falls, and that's now got a 40% weighting. And the second wave, this is the one I've had to update a little bit because of what's happened with Victoria, because my own view is it's quite likely that we're going to see second wave outbreaks elsewhere too. I think it's quite unlikely they're going to be able to actually trap the virus. So in that scenario, you've got very low rates, you've got much higher levels of unemployment, and you've got more home price falls. That's now got a 25% weight compared with 20% last time. And then the last one is the uncontrolled pandemic, where effectively the whole thing just blows up. I give that a 5% weighting. I mean, if we go down the track of the US, for example, this could be really, really serious, but I don't give it much weight. I think that it's somewhere in these first couple we're going to see where we are. And it goes back to what extent the virus will get under control, to what extent that will be responded to in terms of fiscal stimulus, and I'm expecting significant extension to JobKeeper and changes to JobSeeker to provide more support for more households and businesses into the next 12 to 18 months. Because if they turned it off in September, then we're probably looking in these scenarios, second wave disruption and worse. Whereas if you do more fiscal, you might get away with a little less. So there you go. That's pretty much my scenarios. And I'm now going to come back to the Q&A and just give you a little bit of a view of, this is the studio from another angle. See, I've got it live tonight. I normally put this in the overlay for the just edited version, but I thought you might be interested in just to see me here doing my thing, and this is how it's all set up. So there you go. I might come back once more later on. Now let's have a look at some of the questions. Okay, now I'm not going to start answering specific questions on postcodes yet, because once I get into postcode land, we're never going to get out of it. So I'm just going to have a quick look down and see what some of the questions are. I love this one. I've put this one up. If it comes up, there you go. This is from AI. Martin's predictions keep changing. He always wrong. Enough with predictions. Just report what's happening. No. You don't understand. These are not predictions. These are scenarios. There's a fundamental difference between predictions and scenarios. Scenarios give you a sense of how I think things could play out and the relative weighting. You have to be more sophisticated to understand what I'm actually doing. It is not just a prediction. And I'm misreported all the time based on what I say. These are scenarios. This is just giving you a relative weighting. And I've shown that there is an opportunity for prices to rise, there's an opportunity for prices to fall. It's somewhere in between. But at least you can get a bit of a sense of the relative weighting. And it's mathematically driven off the models. So, yeah, I'm afraid that that's a bit off AI. I don't agree with your comments there. All right. Okay. Now, what else have we got here? Okay. Lots of cross chat. Auditing the Fed. Yeah, it's probably could be done. I'm not sure who's going to audit the Fed. The Fed's By the way, I'm not sure that Fed is actually supporting capitalism, but that's another story. You might have seen my post the other day that I went into that in some detail. Okay, let's have a look. What else have we got? Okay, I'm going to pick up one of the questions that I had in beforehand because I think it's actually quite a good one. I'll do it now. So Pete asked, can you make some comparisons between 2000 and 3000? You know, there's the CBDs of Sydney and Melbourne, because he's trying to understand a bit more about the two. So here is the postcode database, and I preloaded Melbourne and Sydney. And this gives me the opportunity of showing you how the database works now. So basically, for each postcode, I have the number of estimated households in the postcode. I have the proportion who are borrowing, the proportion who are renting, the number of properties for rent in the postcode, the number of rental property owners. And it's interesting, if you sort of compare the two, you can quite often see that there are multiple property owners. Remember, those rental property owners don't necessarily coincide with the rental properties in that postcode. Remember, I'm looking at it from a different lens. Then the number who with mild mortgage stress, the number with severe stress, the percentage in mortgage stress, the risk of default over the next 12 months, in other words, how many will fall over, the percentage default in 12 months, then the number in rental stress, the percentage in rental stress, and then the number of stressed investors in the postcode. Again, remember, this is nothing to do with where the investment property is, it's to do where the investor is, and how many of them are severely stressed, and what percentage of investors are stressed. So that's how the model works. And you can see there's some quite interesting differences between Millers Point and 2000 and Melbourne 3000. So one, there are more households in the centre of Melbourne than in the centre of Sydney. There are more borrowing households in Melbourne than Sydney. And there are significantly more renters, 18,000 compared with 10,000. And there are also more properties for rent, 13,000 compared with 8,000. And the number of rental property owners there are actually roughly similar. So a similar number of people live close in and own and own investment properties. Now, the mild mortgage stress is slightly higher in Sydney relative to Melbourne. And as a result of that, the percentage of mortgage stress is 8% for Melbourne 3000 and 27.3% for Millers Point. And the risk of default, though, is a little higher in Melbourne. That's because I'm seeing more stress and strains in the system. And the default risk is 2.2% compared with 1.7% in Sydney. The rental stress, though, is 13,700 in Melbourne relative to 6,500 in Sydney. And that translates to 74.3% relative to 59.6%. So you can see there that Victoria has significantly higher rental stress, and therefore it's perhaps not too surprising that we're also seeing that stressed investors, around 3,000 in each. Severe stress, slightly more in Sydney than in Melbourne, but the percentage of investors, 70% in CBD of Melbourne, and 80% in the CBD of Sydney. So there you go. That was Pete's question. I hope that helped, Pete. And you can see that there's some interesting correlations and comparisons between the two. Okay, what else have we got? That's a very good question. If I can get that up on the screen, I will. So Maria asked, do you regret your 60 Minutes interview? Do you think you were wrong back then or just delayed? Well, no. What happened was they not misreported, but I gave them my scenarios, right, as I do every time. But they only picked the worst example. And then basically I said, well, if everything goes terribly wrong, that's what could happen, right? And I still say, if everything goes terribly wrong, that could certainly happen. It's not my only scenario. It's only ever been one of a number of scenarios. And yet, of course, they wanted the headline. So, and if you remember the Media Watch review that happened at the time, I actually made the point in that essentially I think they should have presented a range of scenarios rather than just the one. But of course, they wanted to go for the headline. So no, I don't regret it. And it did at least get the whole issue on the table of the risk of mortgage slides. And, frankly, prices fall, big mortgages, you got issues. And of course, I always said the critical issue was going to be what would happen to the unemployment rate. Because unemployment's the key here, right? If unemployment comes back to a low number quickly, then we're fine. We're free and hose and can carry on. But the more that I see the data and the more that I look at what's happening in Melbourne and those things, the more I'm convinced that unemployment will actually be lower, higher for longer. In other words, less jobs, less work hours, and more people struggling with partial employment from all sorts of different areas. So I think it's a big deal. Okay, and here's one. We'll just talk about that. Where do you see the Aussie dollar going? Yeah, good question there. It's just nearly back up to 70 now, right? It's a question of what happens to the US dollar, right? Because the US dollar essentially is where it's all at. My own view is the Reserve Bank would like to have the dollar down at 50 to 55 because that would actually import inflation and it would actually help with the inflation targeting here locally. But I'm not sure that they have the capacity to pull the dollar down because they've basically taken interest rates to as low as they can take them. So it's really a question now of how the international markets play out, and that's going to be a function of two things. How much the central banks pump the liquidity into the system, and what's going to happen with the US and with Trump and the election in November. I think if the election goes Trump's way, and some are saying it's quite likely, I think the Aussie dollar will probably be roughly where it is now, frankly. If you get Biden in, you might see some change there, and that might take the dollar down. But I can't see how the RBA can pull our dollar lower. So I'm no more now of the view that because of all the liquidity that's been thrown in, it'll be towards where it is rather than actually down at 50 to 55. And in fact, I have seen some people suggesting it could be as high as 80 in the next year or two. So that's what I'm thinking. Could be wrong, but as with all of these things, it's just an opinion, and as with all opinions, they can change. This is one from Dean saying, banks already stated they won't support loans indefinitely. We're already having tough conversations. Yeah, it's quite interesting. We know that September is going to be a big deal, and we know that they will probably have to do something. They've been talking to the government about essentially padding the transition out over a longer period. APRA has given them plenty of wriggle room. They've basically said, yeah, if IRB banks, in other words, the banks who run their internal risk models, look as though they're distorted, that's fine, just ignore it. On standard banks, don't worry, you don't have to mark to market. So they've been given lots of latitude there, and ASIC said, no, you can change them onto different lending standards and interest only if you need to. So, the regulators are giving everybody huge amounts of freedom. But at the end of the day, a loan is a loan is a loan. It has to be repaid at some point. So the question is, at what point do the banks essentially say, we have to start taking seriously what's going on? Now, of course, the risk is, with house prices probably sliding rather than growing, there's more negative equity risk. And the second is, if unemployment stays high, then default rates are going to rise. In fact, the latest data from the ratings agencies showed that defaults were rising, and I think they will continue to rise. So at some point, unless there's a massive turnaround, we are going to see this as a real big issue. And some lenders are being much more controlled, shall I say, than others in terms of actually what they're doing. But there are some banks who are lending big time, very happy to move people onto interest only, very happy to postpone repayments, hoping that things will recover later. Question is, will they? Not sure. Now, Monty13 has asked, thank you very much for the contribution as well, by the way. I appreciate that. Which Aussie banks do you think are the most sound and the least and the least exposed? Well, it's always interesting because it depends what lens you use. So if you ask the question, who's got the biggest mortgage portfolios, then that's obviously Westpac and CBA. Westpac has a higher proportion of interest-only loans. The other big two organisations, NAB and ANZ, have been essentially losing share relative to CBA, and Westpac has been reducing its mortgage portfolio as well. CBA has been growing its portfolio, although some would say that CBA has a better underwriting process. I'm not sure whether that's true or not, but that's certainly what some people say. So it's quite hard to pick winners when it comes to, and of course there's very little good information other than the very high level generic stuff in the annual reports. There is no dashboard in Australia as there is in New Zealand for individual banks to be able to make comparisons between individual banks. In terms of Macquarie Bank, my own personal view of Macquarie, and I've watched them for quite some time, is that they're actually pretty smart. They know what they're doing most of the time. They do make big calls, and I think they are making calls on the property market. They've been writing quite a lot of investment loans at the moment, but they are actually pretty sharp in terms of that. And some of the foreign banks like ING are, again, quite well run. I'm a bit more nervous about some of the regionals. I think that they've got bigger issues and the pressures on them to try and grow their loan books. Their funding costs are perhaps a little more extreme. So I'm a little bit more nervous about some of them. But, the point I want to make is that pretty much all the banks in Australia are directly or indirectly being supported by the Reserve Bank and by the government. I don't think there's much chance of a bank falling over anytime soon, touch wood, simply because of the fact that the government and the Reserve Bank has proven their ability to throw liquidity at them. And, if you'd asked me that a year ago, I would have had a different view. I would have thought that they would be more on their own. But no. It seems to me that our banks are fundamentally underwritten by the government. And therefore, the ratings of the banks are closer to the ratings of the country than in some other countries. So I don't think there's too much concern at the moment. But there are, of course, always things that are never disclosed, and there are always issues that probably will come to the surface later. But the critical question is unemployment and property prices. If unemployment continues to rise, if prices fall, those are going to put pressures on pretty much every lender, because every lender in Australia pretty much is really a big building society. Okay, this is a good one. Thanks, Ken, for that. So please write to support the Banking Amendment Deposits Bill 2020. Yeah. Now, this is just on this. This is the question of bail-in. So can deposit accounts be bailed in or not? In Australia, it's not totally clear. In New Zealand, it's totally clear. In New Zealand, sure, deposits can be bailed in. They can be converted to equity if a bank gets into difficulty, and that allows them then to reconstruct the bank and keep the bank going, which means that, for example, in Australia, if that happened, the deposit insurance scheme would never be triggered because the bank would never fail. So that's the thing. Here in Australia, it's much less clear. But there is this amendment which has been posted and is, in fact, subject to a Senate inquiry. I put my submission in earlier in the week. And essentially, it's quite a legal argument around to what extent the any other instrument phrase refers to deposits or not. What they've tried to do with the amendment is to effectively clearly define deposits as essentially not bailable, because at the moment it's very unclear. Now, there's a bunch of arguments that you can throw up to say that the existing legislation is already clear, but it's very unclear, frankly, and there are lots of people with lots of different opinions. So this is a way of making it simpler. So if you feel strongly about it, there is a chance to have your say by making a submission. I would recommend that you make a submission formally rather than actually just throw an email, because if it's an email, it will just be received as a communication or a correspondence and won't necessarily be counted in the assessment of the bills. But there are a number of people putting in quite lengthy submissions, including John Adams, who's done a lot of work on this. My own submission is somewhat shorter, but it makes hopefully the points clearly. And I think there is an opportunity here. If we can get that amendment in, and it clearly say deposits are excluded, then the whole question of deposit bail in Australia is off the table. The problem I have is that internationally speaking, the Financial Stability Board and the G20 had endorsed bail-in as a valid strategy for dealing with banks. So it'll be interesting to see whether, in fact, our government allows this to go through, or whether they actually try to stop it. If they stop it, if they put up arguments to say it does not required, or it might be some other argument, then I'd get a bit more nervous about the bail-in situation. But as I said earlier on, I have to say that the liquidity of banks is pretty much secured now by the Reserve Bank and what they're doing. So I'm not as concerned as I was a year or two ago. And I've still got money in the banks at the moment on the principle that it's better to have money in the system rather than outside of it. Others will disagree, but that's my own strategy and my own view. Right, what else have we got? Oh, so many questions. Okay, I'm just going to do another postcode. Let me just put this one in. So this Bob asked me earlier on to do a postcode. I'm just going to put this one in. Let's clear the list. We'll put 2710 in. Hope I've got this right. Okay, and get that one there. Apply. Okay, yeah. All right, so let's go across to the, this is 2710, which includes Coldwell and some other places that I find it difficult to pronounce, so I won't even try. Wacool, possibly, 2710. Anyway, there are 5,000 households there, of which 1,500 are borrowing and 2,260 are renting. There are 1,754 properties for rent. There are around 1,000 property owners living in the area. 215 have mild mortgage stress of those with a mortgage. No severe, 14.3% in mortgage stress. The risk of default over the next 12 months is 26, it's quite low, 1.7%. The rental stress, 884 of those renting are in difficulty at 39.1%, so that's a little bit below the national average. The stressed investors, 133, of which 33 are severely stressed, so that gives you a 15.4% rating for investors in that postcode who are stressed. So relatively speaking, that's actually pretty good relative to many other postcodes. So not too much to see there in my view, which is perhaps good. I just want to go down and acknowledge Reverse French for his contribution. Thank you very much for that. I really appreciate your support for what we do. Death and Regret, thank you very much. And your question is, do I think gold is money? Well, medium exchange, store of value, etc., etc. It pretty much has quite a few of the attributes of money. The point, of course, is it's quite hard to necessarily convert it right easily. So fungibility is my key question. Fungibility means, can I convert it to buy for fish and chips? If you take a gold bar, it's going to be hard to convert. So that's the one issue I've got. And the big question I have with gold is that if you hold gold, and you hold it, in your house, you've got to store it somewhere, and then you've got to convert it if you want to use it. So it's not got all the characteristics of money. On the other hand, there are many people who would argue that it's a more stable foundation of a currency than the false currencies we have at the moment, where effectively central banks can blow up the value. And as you know, I've made the point several times that there's a big debate about whether inflation or deflation is going to be the story of the day into the future. If inflation is going to be the way, then gold potentially is a protection against inflation. In other words, the devaluation of our sort of paper money, as it were, fiat money. If you think deflation is the story of the day, then maybe gold won't be such a good value holder. And in a way that's difficult to know whether we're going to get inflation or deflation. Different people have different points of view. I interviewed the other day somebody from the US who's a very good macroeconomist and analyst, and his view was deflation first and then inflation later. So interesting. So yeah, so my view, it's got some of the attributes of money, but not necessarily all of them. Okay. And Michael asked, great show, Martin, thank you, and thanks for your contribution. How long can banks hold up before enforcing sales on those who can't meet payments? Is there any data out there? Well, what's interesting about that is that if you look at what happened in the global financial crisis in the US, banks held off foreclosing for years because they didn't want to flood the market with lots of properties into a falling market. So there were lots of people who effectively ended up paying no mortgage for quite a long time. And banks ultimately ended up selling on those properties at a deep discount to somebody else to hold them. So I wouldn't be surprised to see asset sales. In other words, distressed loans and properties being sold to other entities, hedge funds, those sorts of things. Once that happens, hedge funds are much more aggressive in terms of their foreclosure routines. But I don't think it's going to happen anytime soon. I think that we're going to see this just run for perhaps 6 to 12 months. We'll see mortgage stress still rising. We'll see probably more defaults, but not massive defaults. But if unemployment stays high, ultimately it's going to get into a situation where banks are going to have to start foreclosing. And there's a very significant PR question about foreclosure, which is one reason why they prefer to sell the assets onto somebody else rather than be seen to foreclosing in their own right. The other point to make is, of course, that if you a securitized pool, a lender has the opportunity of swapping out a bad loan and a bad property, as it were, for another one. So expect to see some jiggery-pokery in the securitization pools to maintain the security in those pools as well. Haven't seen much of that yet, but APRA, in fact, came out today with a change to the FAQs to cover just that scenario, which means that they're thinking about it. Okay, now let's have a bit of a go here. Postcodes, SS Tech, let's see if I can do that one. 3082 and 3076. Let me just try and put that in for you. I know this is very exciting TV, isn't it, when you're watching me clear my list and put some new postcodes in, but there isn't a quick way of doing this. 3082, we'll add that one, and then we'll add 3076. We'll add that one too. Okay, and then we'll apply. Make sure it comes up. Yeah. Okay, let's go across to the old screen. There you go. So this is Epping and Mill Park in Victoria. So 3076, 11,000 households, 6,000 borrowing, 4,000 renting, 3,200 properties for rent. Rental property owners are just over 3,000. Mild mortgage stress, 3,888, which is 64.6%. So that's very high, much higher than in Mill Park, as we'll see in a second. Risk of default, 115 at 1.9, so that's not too bad. Anything below 2 is probably reasonable at the moment. Rental stress, 2,282, which is 52.9% of those renting in difficulty, so that's above the average. Stressed investors, 525, of which 75 are severely stressed, and that's 19.7. So many property investors in that area are okay, few aren't, but I'd be looking at the mortgage stress data as the critical point. So clearly there are people there with difficulties. That probably is enough to put price pressure on the area. Now, in terms of Mill Park, 10,000 households there, 5,000 borrowing, so roughly similar ratios, 3,100 renting, 2,400 properties for rent. The number of rental property owners, just over 3,000. Mild mortgage stress, 1,926. No severe stress, 38.1%. So compared with 64.6, mortgage stress in that adjacent postcode is much lower. Risk of default, 1.7, that's slightly lower. Rental stress, 1,982, which is at 62.1%, so slightly higher than the previous one. And stressed investors, 453, of which 76 are severely stressed. And that means that the percentage of investors who are stressed is 17.1%. So not huge, but significant. So I hope that's helped you with that one. Whoops, let's go back to the main camera. My M, thank you very much for your contribution. I really appreciate that. John says, buy Martin a coffee, you miserable cheapskates. Thank you very much, John. I appreciate that. Vanessa says, good evening, Martin. We love your work. Do you have an update on the 10K cash limit and any thoughts on the banks limiting cash withdrawals? And thank you for your contribution, Vanessa. So two things to say. There is no progress at all in terms of any news from the incumbent government with regard to any change to the fact that they were asked to go do more work on the cash ban following the Senate inquiry. They've done nothing. And the hypothesis that we're running with at the moment is that they are choosing to do nothing rather than just too busy to do nothing. And therefore, the chances are that the cash bank thing will probably dissipate. But, of course, since COVID, more businesses are now essentially going for the non-cash route. And of course, many banks have been mailing debit cards to people so that they can use them instead of cash. So there is a move afoot to effectively replace cash with electronic through a different mechanism. But in a way, I'm less concerned about that insofar that if it's a choice between the two, that's fine, because of course the cash ban was going to effectively take away a civil liberty that we had to settle in cash if we wanted to. And at the moment, there's no evidence of that actually happening. So my own view is, I think that we'll continue to watch it, but it's unlikely that we're going to see the cash ban come in its current form. And the amount of work they'd have to do to recraft it would mean it's probably off the agenda for some time. They probably will never actually come back and formally declare it a closed issue. They'll just keep it quiet, a typical Sir Humphrey, and just carry on with this other stuff. So that's my read on the situation there. Now, Monty13 says, which Aussie banks do you think are the most sound and least exposed? I think I answered that earlier on, didn't I? So I won't do that. AI, thank you very much for that contribution. Appreciate that. And MP, thank you for that too. Given China's extremely high debt levels, are you expecting a major banking or currency crisis there? If so, when? Well, the thing about China is it's hard to know quite what's going on, right? Disclosure's quite low. What I will say is that we know that they've been reducing the capital ratios for the banks up in China. And we know that the debts are very high in China. Now, because the system there is really centrally controlled and centrally managed, they keep, when a bank falls over, they just get it amalgamated or otherwise changed, and then it continues. So in a way, it's probably not the same as a Western banking crisis. I suspect that it'll go on for quite some time. I expect they'll throw more liquidity at it. I expect they will reduce capital further. The Chinese economy is beginning to turn around. The COVID is under control there at the moment, and it may well be that in fact the worst of the crisis is past. So it's not, necessary that there will be a crisis. They're also holding liquidity more than previously, so they're stopping people from shipping money overseas. And they want people to bring money back to China. And that's providing more liquidity locally too as well. So all of those factors suggest to me that the risks are somewhat lower than many people think. But, as all of these things, the transparency is not that great. Okay, what else have we got? I thought some more postcodes there, which I'll do in a moment. This is a very interesting comment from Jess. Afterpay doesn't solve over-indebted population. That's very true. Afterpay is a very interesting phenomenon insofar that it doesn't create new credit. It just basically makes people use their existing credit facilities more, or indeed, if they use a debit card, then they have to pay, in four sequences to be able to actually pay it off. And around 25% of people who've used Afterpay end up paying fees, quite big fees. And that's something which a lot of people are not fully aware of. So it seems like it's a home run. It seems like it's a way of spreading out your payments, but there are huge risks. And unfortunately, quite a few people who have Afterpay facilities also have credit cards and have other debt mechanisms too. So in a way, it's just a debt extension strategy. And the problem I have with all this debt extension is it just makes the problem worse and worse. And of course, debt is wired into the way the society works, and debt is wired into the way that people are expected to behave. It's a consumer society. You use your credit card or you use Afterpay to buy what you want and worry about paying it off later. The trouble is that the music ultimately probably is going to stop. And interestingly, I did a show a few days ago with Steve, who actually is one of the experts in credit cards, for example, and he made the point that interest rates on credit cards are higher than they were. So that's from CanStar, I should say. So, you can pay a lot, and Afterpay is a way of paying less if you pay it off. But if you don't pay it off, then you end up paying a lot more. So it's a big deal. And I personally am quite skeptical of those systems. I know that they've had a huge run on the stock market. I think they need more regulation personally, but I don't think that'll happen because the regulators are, again, asleep at the wheel. Okay, that's his one. Let's do this one. So Michael says, Coff Harbour 2450. Okay, try and put that in for you. Clear the list. 2450. Okay. Apply. Oh dear, what happened there? Right. Need to hum up my skills, don't I? Let's get rid of that so you can see the answer. Okay, 2450. So this is Coffs Harbour and the area around there. 19,000 people borrow a household, 6,000 borrowing, 8,000 renting, 6,500 properties for renting. The number of rental property owners 5,500. Mild stress 1,185. Severe stress 2 to 4, making mortgage stress 22.9%. Risk of default 191. Default over the next 12 months 2.9%, so a little higher than some, but not massive. Rental stress 5,859 at 67.9%, so that's quite high. That would suggest a number of people are going to actually potentially be in some difficulty. And stressed investors 1,721, of which severe stress 379, making 38.1% of investors stressed. So the thing to look at there, in my view, would be the rental stress, which at 67.9% is quite concerning. That would suggest that quite a few people are beginning to struggle with making those repayments at the moment on their rents. And mortgage stress itself is not too bad. It's below the national average. Okay, so let's go back to there. Another postcode, 4127. I wonder what that is. I haven't quite memorised every postcode across Australia yet, although I'm getting there as I do more of this. Of course, there are quite a few. I should explain that the analysis is done at a postcode level, not a level below that, simply because there has to be some degree of managing the whole process. Okay, so Natalie, this is yours. There you go. So Daisy Hill, 4127, 10,000 households, of which 4,500 are borrowing, 4,280 are renting. There are 3,262 properties for rent. There are 2,100 rental property owners, 3,400 in mild mortgage stress, no severe stress. That is those 76.7% of people with mortgages in stress. So that mortgage stress is very high. Risk of default, quite low, 106, but 2.3%. And rental stress, 383, 8.9. So not too much rental stress there. Mortgage stress is the real story. That would suggest more pressure on prices ahead, I would have thought. Stressed investors pretty low at 281, which is 13.3%. So there you go. I would suggest that quite a few of those investors are not holding property in that particular area but elsewhere, which is often what we find. It's quite interesting looking at the relationship between where people live and where they invest, and quite often they're investing in different locations. So there you go. What else have we got? Another one. Here we go. Pradeep, 3087. Okay. 3087. Clear the list. 3087. And that. Apply. Okay, here we go. And better kill that so you can see it, eh? There you go. So that's Watsonia, 3087, 3,724 households, 1,649 borrowing, 1,170 renting, 885 properties for rent, number of rental property owners 497, mild stress 1,531. Percentage in default, this is pretty big, 92.8%, so a lot of people in difficulty. Default risk, 33 or 2% over the next 12 months. Rental stress, 252, which is 30%. and stressed investors only 6.6. So the critical issue there is mortgage stress. A lot of people on the outer suburbs of Victoria, and we see that again and again and again in and around Victoria. As I showed you earlier on, quite a few of the postcodes in and around Victoria are hugely stressed. The property sector in Victoria is the thing I'm most concerned about. Of all the states, I think Victoria and around Melbourne in particular is going to definitely be under pressure ahead, I think. Okay, Dean, did I do that one? 2095. No, I didn't. Okay, let me just see if I can get that up on the screen. Okay, we'll do it that way. Right. Dean, thank you for that. I appreciate your contribution. It really is very helpful. And I've explained before, I don't make profit from this exercise. It's all about just helping to cover the costs of what we do. Believe it or not, there are quite a lot of costs involved in creating DFA and creating all the content. Sometimes a bit of extra finance makes a huge difference to what we can do. All right, so Dean, this is Manly. Okay, this is 2095, 8,478 households, of which 1,022 are borrowing, 5,459 are renting. There's 4,133 rental properties, 3,016 in mild stress, none severe stress, and that makes a 56.7%. Hang on, play that again. Number in rental property owners, 3,016. Mild stress, nothing. Severe stress, 948. So quite a few people are in difficulty, cash flow wise. 56.7% of people in that postcode in mortgage stress. Risk of default, this is quite high, 5.9% or 99. And rental stress, 1,950, which is 35.7%. Stressed investors, 1,334. Severe stressed, 290. And that's 53.8%. So you can see there that mortgage stress is significant, 56. That's above 50. Anything above 50 is very concerning. Expect prices to fall. And particularly when property investors who are living in that particular area are also at 53.8% under pressure too. So I think that will probably be my conclusion. Manly prices will slide. Okay, what else have we got? Let's do that one there. Litter. I like the doggy picture. Very good. 2912. As you may know, we have dogs, so react very positively to doggy pictures. Okay. 2912. Yeah, get rid of that. And then go to there. There we go. So this is Gunhain in regional around the ACT. 2,336 households, 862 borrowing, 1,427 renting, 1,068 properties for rent. Number of rental property owners, 725. Mild stress, 96. No severe stress, so 11.1% of mortgage stress. Risk of default, 10, 1.2%, so that's below the average. Rental stress, 204. 14.3% in rental stress, so that's quite low. And stressed investors, 250, which is 34.5%, which is, you know, a little bit above the 25% average, but not too bad. So my read of that is that property investors probably are the ones to watch there. Many of them will be perhaps owning properties elsewhere, but so far as mortgage stress is concerned, it looks pretty good. Rental stress, not really too much of an issue at the moment with that sort of size of number coming through. So there you go. That's that one. Okay. Robert. 4114. 4114. Take that. Apply. Okay. So that's Woodridge in Queensland. 10,950 households, 2,719 borrowing, 7,225 renting, a lot of renters, of 5,379 rental properties. The number of rental property owners, 3,433. Mild stress, 1,020, which is 37.5%. Risk of default, 60 over the next year at 2.2%. Rental stress, 2,210 at 30.6%, so that's a bit below the national average. Stressed investors, 1,164, of which 116 are severely stressed, and that's 37.3% of investors. So really, mortgage stress, little around the average, maybe slightly lower. Investor stress, a little higher, but not as severe as some of the postcodes that I've seen. All right. What else we've got? 3335. Clear list. 3335. Apply. Come on. Apply. Okay. All right. This is Plumpton in Victoria, including Rockbank in a regional Australia, 3335. So 2,193 households, of which 1,553 are borrowing, 719 are renting. Properties for rent, 538. Number of rental property owners, 325. Mild stress, 725, which is 46.7% in mortgage stress. 37 risk default 12 months. Percentage risk of default 2.4%. Rental stress 431 at 59.9%. 36 stressed investors at 11.1. So the question there, of course, is mortgage stress, which is pretty bad, and rental stress. So we're also a relatively small postcode, and you could argue that it's a relatively small count. The proportions are quite significant, and I'm seeing this number of regional postcodes across the country, that whilst the big numbers are close into a lot of the major centres, some of the smaller ones are looking pretty difficult as well. Okay, here's one. New Vision Printing. I'm going to do that. 2760. Add that. Apply. Okay, this is Gullerton. I think that's how you pronounce it. Could be wrong. This is Oxley Park, St Mary's, New South Wales. 12,782 households, 5,179 borrowing, 6,534 renting, 4,902 properties for rent, 4,994 rental property owners, 3,747 mild mortgage stress, none in severe stress, 72.3% in mortgage stress, 77 risking default at 1.5%, 5,208 in rental stress at 79.7%, so that's a big number. Rental stress is your problem, I think, there. 1,488 stressed investors, of which severe stress 926, and investors that are stressed 48.3%. So investors renting rather than mortgage stress perhaps is the investing is also significant. Mortgage stress, of course, there though 72.3% is the big deal. Okay, thank you very much, Peach One, for your contributions. Very much appreciate it. I've got one here. Love your work. Can you please show us data for 2263, the Central Coast? Yes, I'll do that one, and then I'm just going to move on to the rest of my presentation. Clear list. Okay. 2263, 2263. Okay, well, add that, apply it. Okay. 2263, which is Noraville. It includes some of these other areas too, including Nora Head. 11,239 households, 3,414 borrowing, 5,249 renting, 4,036 for rent. Number of rental property owners, 4,308. Mild stress, 1,295. No severe stress at 37.9%. 100 risking default in the next 12 months, 2.9% over the next 12 months. Rental stress, 2,566 at 48.9%, so quite a lot of rental stress. And stressed investors, 1,400, of which 287 are severely stressed, and that's 39.2. So as I see in quite a few of the Central Coast areas, there are high levels of stress, and it's touching mortgage stress, rental stress, and investor stress differently in different postcodes, but it's certainly an area to watch in my view. Okay. Now, what I want to do is just to go back to there. Okay, I'm just going to go back to my presentation and just go through we're coming up to 9:30. I'll still do a few more postcodes a bit later, but I'll just do this. Just in terms of, if you want more information about what we do, the DFA blog is available and contains a lot of information. All of our posts go up there. A lot of other information goes up there as well. You can subscribe. There's a thing saying subscribe to the DFA blog. If you do that, you then get alerts every time we post. So that might be something you want to do. It's free, so there's no cost involved in doing that. You can also support our work via Patreon. I just wanted to highlight this in a bit more detail because we've done some enhancements to Patreon. Firstly, it's worth highlighting they now are obliged to charge GST, so that's actually made some changes to that. But we have 5 tiers now. A basic support, $3 US a month, just to help us out, or a bit more, $10 a month, where you actually get access to some additional content and early research, or $25 a month, which I call DFA Plus, where you can do more to support us, but also get more access to, for example, some of my other interviews. When I record TV interviews, I will often record the whole interview and put it up there so that people can actually see it. You might only get a minute on the TV, but you might get 10 minutes of interview from me. So that's one of the things that I do. And then I've got DFA Stress at $50 a month. If you want the full stress data set for all 2,000 postcodes across the country, you can subscribe via Patreon, and they'll get mailed to you pretty much. In fact, I sent them out yesterday for a number of patrons who actually have already subscribed. So that gives you all of the data in my data set that you saw tonight for every postcode in the land. And if you want to sort of track what's going on, that's probably the best tool, $50 a month. This is all US dollars, I should say. And then if you really want to go the whole hog, at $500 a month, you can also subscribe to receive my full data set each month, more than 120 fields of data by 52,000 house postcodes for a full year. Each month, 4,700. So you get basically a monthly drop of 4,700 households for you doing your own modelling and comparisons and all those sorts of things. So those are the things we offer via Patreon. And we have a healthy number of Patreon subscribers and supporters, but always room for more. And it is probably, a bit of a set and forget way of doing it, but it really is a very powerful way of supporting what we do. So consider that. On the other hand, if you want to make a one-off donation, you can do it via PayPal. And there's details there, PayPal me, Martin DFA. That's a great way. People occasionally do that too, so thank you for that. Or even Bitcoin. If you want to use Bitcoin, there's a QR code there that you can use. And I've had very small bits of Bitcoin from a few people, but a lot of people said, you must do Bitcoin. So I did, and well, got a few, but not a lot. So there you go. In terms of merch, there is this DFA Design Intelligent Insight Today, which I've got plastered on mugs and shirts and bits and pieces. So if you're interested in that, you can go to the store there. It's also available direct from the YouTube channel as well. I had a few people essentially use that, and a nice slice of the profit goes back to me to help. But obviously the bulk of it is on the production of the articles, but we do actually make a little from those if you use that. So that's another way of supporting us. If you'd like a DFA mug, they're not cheap, I have to say, but that's because of the way that Teespring works. I couldn't do it for any less, so I'm not making massive profits, but I am making just $1 or $2 on each one. In terms of top hits this month, Steve Mickenbecker, that's from CanStar. It's worth watching that show if you've got a credit card, because we talk about how you can save some money on credit cards, and in the current environment I think that's pretty important. I did an interview with Brian Martin, an emeritus professor, talking about what's really going on with things like royal commissions and some of the other things that are actually there. In other words, the processes that you think are going on about regulation aren't necessarily the process that's going on. Recommend that. Had fun with that. Tony did another show quite recently. Tony's always great fun, and calls it like it is. If you've not caught up with his show, do watch that. And Steve Van Meter from the US, The Markets Are Disconnect from Reality. That's the guy I mentioned earlier on about macro. He's really, really good, I think, and we'll do some more shows with him on what's going on in the US, because he's got a really good handle, I think, on some of the critical issues, and particularly, as I said, he's deflation rather than inflation orientated. And then just on the other channel, if you want more information about that submission for Friday, the submissions close on Friday relating to the amendments to the bail-in legislation, go across to the Walk the World channel and look out the post Coalition MP lets the cat out of the bag on bail-in. That's basically John Adams and myself talking specifically about the legislation and the change, and there are links there to be able to go across to make a submission if you are so inclined. It's an important issue, as I discussed earlier on, and if you've got time, doesn't have to be a long submission, but make a submission. It needs to be in by Friday, because there's a chance we can kill deposit bail-in dead if we can get this change to the law passed. Okay. Now, the only other thing I just want to mention is that next week I have a live Q&A session with Veronica Morgan, who's property realist is what she calls herself. I would say she's much more bullish on property than I am. But I've had a number of people say over the years, why don't you try and get somebody who's more property positive on? Well, Veronica is more property positive, but she's also very much a realist, I think, and actually makes some really good points. So she'll be on next week for a Q&A session. So you can ask her whatever you like about buying property, selling property. You can ask her about location. You can ask her about her property academy and some of the books that she's written. So I think that'll be a fun show. That's 8 p.m. Next Tuesday. So mark that in your diaries. We'll put the link up on the next day or two for that. And again, if you've got questions ahead, I'm very happy to record those ahead of time or as normal on the live stream. So that's pretty much that. Again, hopefully a recommended and useful show. Another question to ask you is, do you like the live Q&A with other people on? Like, we've had Tony on, we had the Nucleus Wealth guy on last week, and we've had a few others too. I'm just trying to get a sense of what the mix between me talking and presenting my data versus me having an informal chat with other people. Be interested to get your feedback. So tell me what you think. Do you want more? Do you want less? Who would you like to come? Who would you like for me to come back on? And are there other people you'd like me to have a conversation with live? Always happy to take thoughts and recommendations on that. Okay, so with that there, I must tell you that I haven't got much chance to do a lot more postcodes, but I will do just a couple more. And I will then give you a clue as to how to get the data if you haven't had it today. I know that there are lots of people who asked and I haven't been able to process them. It's just the The fact of the matter is, I've only got one pair of hands and I've only got a limited amount of time that I can spend on this. But nevertheless, I'm doing Anthony's 3220. Okay, apply. Okay, so this is both in Victoria, Huyton and Newton, Greater Geelong. So Huyton, 23,345, so that's a large number. 9,792 borrowing, 8,624 renting, 6,508 properties for rent, and 7,935 rental property owners. 3,775 in mild stress at 38.6%, so, around average. 281 risking default, or 2.9%, so that's slightly higher than some, but not dramatic. Rental stress 4,079 at 47.3, so that's a little higher. So it looks to me as though there are some signs of stress there. And stressed investors 1,913, of which severe stress 345, and 28.5% of investors stressed. And then if we go to Geelong and Newton, or is it Newton or Newtown? I don't know which way it's pronounced. 7,843 households, of which 2,400. As you were. I'll do that again. Sorry. Apologies. 23,345 households, 9,792 borrowing, 8,624 renting, 6,508 properties for rent, 7,935 rental property owners, and 3,775 in mild mortgage stress. 38.6% of those in mortgage stress, so, about average. 281 risking default, 2.9%. 4,079 rental stress, 47.3% in rental stress. 1,913 stressed investors, of which 345 are severe stressed, making 28.5% of investors stressed. And then the other one, this is Geelong, 7,843. That's the number of households. Borrowing 2,453, 3,797. But renting 2,898 properties for rent, 1,512 in rental property owners, 2,000 in mild stress, none in severe stress, but a high number, 81.8% in mild mortgage stress. So cash flows, big cash flow issues there. 55 risking default at 2.2%, 2,109 in rental stress at 55.5%. So again, rentals also quite high. 492 stressed investors, none severely stressed at 32.5%. So there we are. Okay, well, I think I am pretty much done. I want to just say thank you very much for spending some time with me on the show tonight. For those who have not been able to get the postcode information they wanted, there is an alternative route that you can use, and that is if you send me your postcode directly via the DFA blog using the message facility, just ask for the postcode. I will, over the next couple of days, pull out the information and email it back to you. So that's a commitment that I can make. And if you've got 2 or 3, I'm happy to do 2 or 3. If it gets too long a list, then it's probably not going to happen because it's just going to be too difficult. But nevertheless, I think it's quite important that people get a feel for what's happening. I'll update the stress data again next month, and when I'm on again in a couple of weeks, I'll also have the database online again then as well, so we can potentially spend a bit more time on that. But, I don't want to spend every show going through postcodes because otherwise we won't be able to cover some of the other things I want to cover. But anyway, I think it's quite important. And I want to make 2 final points. The first is if you are in financial difficulty, mortgage stress or rental stress, and, are wrestling with this, there are things that you can do. The first one is, of course, is to draw up a cash flow so you can see where the money's coming in and where it's going. Then do some prioritizing. And quite often, I find when I survey households, they have very little idea of where the money's going. So that's the first thing, understand where the money's going. The second is if you've got a mortgage, banks are an obligation to assist. So go talk to them early, particularly now with the various facilities and opportunities there are to defer payments and things. If you are feeling the pressure, mortgage pressure particularly, go talk to them. If you've got rental stress, the fact is that the current arrangements are that your landlord should be amenable to a discussion about it. Now, I say should be because many aren't, but that's the official position. So it's worth thinking about that too. And if you are a property investor who is under some pressure at the moment, join the 13% of property investors who in my surveys are now saying they're looking to sell because they can't make the economics work anymore. And that is actually quite a significant commentary, I think, on the way things are. So that's just the fact of the matter, I'm afraid. We are in a difficult situation. I think that mortgage stress, rental stress, and investor stress will get worse. I think prices will slide further. And unfortunately, with the COVID rearranging itself and emerging in different locations, let's hope Victoria sorts it out. If you're locked down in Victoria, sorry to hear about that. Hang in there. We can get through it, of course. But the concern I would have is that if it spreads more widely, then of course it gets more serious. And unfortunately, there is no simple way to solve it. We have to get the health issues controlled before we can get the economy to fire again. And unfortunately, the more that the health issues run on, the less the economy will bounce back. All right, last look at the commentary. What else have I got? Got everything there. Plexus has posted the blog. Thank you very much for that. All right, Amber, I'll do one more. All right, just for you. How about that? I know I'm nuts. Okay. 4740. Apply. Okay. So that's Mount Pleasant. And let's get rid of that. Go across to there. Okay, last one for the night. Mount Pleasant, Mackay, 35,509 households, 13,350 borrowing, 17,575 renting, 13,271 for rent. Number of rental property owners, 7,245. Mild stress, 5,528. No severe stress, 41.4%. So it's quite high. It's above the national average. 386 risking default at 2.9. So that's a little higher than some. 2,600 in terms of rental stress, 14.8%. Not too bad. Stressed investors, 803, of which 73 are severely stressed. And that's 12.1%. So it doesn't look too bad to me. But I'd be worried about that mortgage stress. And I'm seeing quite a few places up in Queensland with significant rises in stress because of the financial pressures relating to COVID and all those things from there. Okay. Well, I want to say thank you very much for your spending time with me tonight. As with always, I've not been able to cover all of the conversations or indeed all of the comments, but hopefully that's been quite useful. We got a peak concurrent of 880, I think. Yeah, pretty much that, 880. That's pretty good. So thank you very much for that. I'll look forward to seeing you next week. There will be some more shows coming out in the next few days. I've got some more interviews planned. Couple of quite famous people will be on, hopefully, if I can swing it. I won't mention them by name in case I embarrass them later, but we've got some more interviews coming. We've got some more content, of course, as well from our other analysis. So I look forward to seeing you there. Thank you very much for your time tonight. Take care, keep safe, keep well, and we'll see you next time. This is Martin North from Digital Finance Analytics, signing off. Bye.